Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 284th VideoCast podcast for the week ending March 27th, 2025. A lot of great stuff to cover today, but as always, family first. I want to congratulate Annabelle and her team. So Annabelle Hayes, Hope Human, Grace Wang, Julia Wang for setting a new national age group record in the 9 to 10 girls 200-yard medley relay with a time of 1:59.74. They also set a new SCS record in the 200-yard free relay with a time of 1:49.30. So congratulations to them. And Annabelle's leadoff 50 back split in the medley relay was 29.72. And her lead off in the split in the freestyle relay was 26.39. So congratulations to them. That's me and Annabelle. Afterwards, she rocked it. That's her with the refs. And then I had a chance to play beautiful Pelican Hill yesterday with my new friends. You got Tony, Daryl, Ray, and that's the beautiful course in the background. Absolutely incredible on Newport Coast. Some more pictures. You can see the views there. I can't believe this is right in my backyard. One of the nicest courses you could play. I mean, it's up there. I mean, I wouldn't say Maidstone, but I'd say like Torrey Pines type of views and experience. It was pretty darn amazing. So I'm going to be playing that one a lot more frequently. Two of these new buddies are actually friends from my new club, and one was down from Vancouver, friend of a friend. So super excited. That was a lot of fun. Media, want to thank Christian Dagger and Ashley Webster, as well as Stu Varney for having me on Varney & Co. on Friday. We're going to listen in here.
Let's check the markets. And again, we are moving lower. The Dow off 460 points, down about 1% across the board. The NASDAQ down just 0.75%. Thomas Hayes joins me now. Good morning to you, Thomas. Hey, if you got the intestinal fortitude, you say it's time to be a buyer, not a seller.
That's right, Ashley. As Warren Buffett famously said, when it rains gold, pull out a bucket, not a thimble. There are a lot of great companies on sale. We're putting in a bottom here, and a bottom is messy. You can go down and retest the lows, but there have been 21 corrections, 10% moves or more downward since 1980. And in the 14 where there were no recession, which we believe this will be part of, 6 months later, the market's up 9% on average. We're seeing sentiment flushed out. AAII sentiment survey this morning, there's only 21% of retail investors are bullish, 58% are bearish. But on the smart money side, what you're seeing is corporate insiders are buying back stock to the largest extent since the lows in 2022.
So the concerns is a slowing economy, prices remaining higher, the dreaded stagflation concern. And with tariffs, it's just uncertainty at this point. I mean, those fears, are they justified?
Well, certainly they're justified, but that's what creates dislocation in prices. They don't give away doubles for free. You have to buy it when everyone is selling in the hole. And this is one of those opportunities. You saw record put buying by retail investors last week. They were buying insurance after the house had burned down. You saw record selling in the hole by hedge funds. These are contrarian indicators. If you buy during these times and you buy selectively and you buy high quality and you look 12 months out later, you've done really, really well. And we're back. Then we're going to start off with some quotes of the week from Charlie Munger, one of my the great people that I look up to. He says, a lot of success in life and business comes from knowing what you want to avoid, i.e. early death, a bad marriage, etc. And this is easy. A lot of people always say to me, gosh, you look so young. I was like, yeah, I don't do drugs and I don't drink much. Like, what else do you want to know? So, things you want to avoid, early death. Robert Arnott, in investing, what is comfortable is rarely profitable. And I think there's a corollary to that, which goes, what starts uncomfortable becomes very comfortable over time, as we've seen in many of the names through the years here on Hedge Fund Tips with Tom Hayes. And then David Tepper, in order to get that comfort, what do you need to do? The key is to wait. Sometimes the hardest thing to do is to do nothing. And that's key. And that's why having a good hobby like golf comes in handy. When you're tempted by the devil of activity, you want to get into inactivity. When you've bought right and you've bought quality at good prices, you just wait and play the time arbitrage game. And that is a unique advantage in the market. Also, the hats. First of all, I want to congratulate the 8 winners who submitted their addresses. If you'll be getting your hats this week. If you are not on this list, I responded to the last YouTube video. If you go to youtube.com, go to the Hedge Fund Tips channel, episode 283. If you look in the comments, I said, you're winner 1, you're winner 2, you're winner 3, you're winner 4. Only 8 of you replied. So if I don't hear from the 2 people who I responded to in the comments saying that you were a winner that have not yet submitted their addresses at hedgefundtips.com, just click on the contact page and send in your email. Do that tonight. Otherwise, I'm just going to pick the next 2 winners and get their addresses and send it out to them for all 10. And while you're at Hedge Fund Tips under contact, also click on terms. This is all opinion, not advice. So let's go through some charts we haven't done in a while. Relative performance of sectors. I think this has been a unique year that caught a lot of people by surprise, but no one on the Hedge Fund Tips with Tom Hayes money train was taken by surprise, because you were ready. The last shall be first, and they were. You can see here, REITs outperformed the S&P 500 year to date. Chinese stocks outperformed the S&P dramatically year to date. By the way, this is a secular turn, similar to what we saw 2016 to 2018, then 2019 to 2021, and here we've put in an even bigger base. The longer the base, the higher the space, and this is just getting going. Then we've got bonds have outperformed the S&P year to date. That took a lot of people by surprise. No one here. Biotech, we love this setup here, putting in the bottom just like we saw here in 2020. You got a bottom, kind of a double bottom type of here, or reverse head and shoulders, however you want to look at it. I think biotech is poised to rocket. We're going to look at some of that. Then materials outperform the S&P. All the stuff that we talked about, if you remember from our last shall be first, you can find all the old posts on Hedge Fund Tips with Tom Hayes. Just go down to commentary. You can see all of our weekly articles going back 5 some odd years, or you can just go to VideoCast here under categories and see every single video cast or podcast if you like to listen. Communication services, looks like it's stalling out relative to the S&P. Energy, okay, you remember, go back to the podcast in 2020 when oil was negative. We were buying like crazy here. We had more pain, and then they just took off like crazy. I remember buying Exxon at $33 when oil was negative and pounding the table on the podcast. Went a little against us before it went off, absolutely took off. And then we were laying off in 2022 and everyone was getting excited about it, and they've basically done nothing since. So now it looks like it wants to take another leg higher. Energy is, again, we continue to pay attention to. We continue to have exposure through Comstock, which has been a home run. Probably be a 3-bagger within a few months from where we bought, already 2+, and just beginning with that one. Financials relative to the S&P has had the huge run. We laid off a lot. We still have some regional exposure. I think on the next major rally, we're going to take that off. believe it or not. So we were able to take off the banks in the summer after a huge run in Citi and Bank of America after the March, remember the March mini banking crisis, we were buying hand over fist, and we took off over the summer. So let's see what happens with that. But we're waiting for the next big rally to get rid of regionals. XLI at a very nice profit. XLI, industrial is starting to outperform relative to, so we look at this to find sectors we want to drill down on to find opportunities. And the key with the opportunities is, I think what most people is, they're like a normal business person's mindset is you get paid for activity. Massive action equals massive results. And I think a lot of people just get distracted by the new shiny object, and rather than holding to great quality businesses. Unless something has changed in our thesis, if we have a new idea, it has to be so much better than an existing idea in the portfolio to take something out that hasn't yet reached full intrinsic value, the value we determined prior to entering the position, in order to replace it. So, but anyway, tech has underperformed relative to the S&P. No surprise to us, surprise to many. Staples have outperformed. They got a little defensive. We like a little exposure there through the Baxters of the world, through the Hormels of the world, but nothing crazy. And same thing with utilities. This is all going to be a function of rates continuing to go lower. We'll talk about that, which we have. Healthcare, same story, defensive, starting to outperform Baxter. I think biotech is going to pick up into that very quickly. Discretionary has absolutely rolled over with consumer sentiment relative to the S&P. There's going to be some opportunity to buy some stuff there. And that's how we kind of an overview. Then we look at bullish percentage. These are the percentage of stocks in the sector on a point and figure buy signal. We don't use point and figure, but this is a useful indicator to see different sectors we have found. Communication services already started to rebound. NASDAQ composites starting to rebound. There's opportunity there. Like I said in previous media interviews, tech and Mag 7 are going to bounce. I do think they're going to underperform for the year, maybe trade back up to the top of the range, which most people are going to say, see, they're the best, blah, 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 and then they'll stall out again. Consumer discretionary, I think there's a lot to do here. The VF Corps of the world. Nike, if we didn't own VF Corp, but Nike has a little bit bigger. In other words, Nike is where VF Corp was a year and a half ago when we got involved with Bracken Darrell. I think it's going to take a little longer than people expect, but I think Nike will be back over time, just not yet and not as soon as most people think. Energy, again, starting to move. Gold miners don't really care. Healthcare, opportunity there. I keep looking at the Pfizers of the world and continue to pass. We have exposure through biotech and through Baxter. Bullish industrials. This is just getting started. The Generacs, the Boeings, the Boeings, the Stanley Black & Deckers. This is all going to be with the construction trade, which we're going to spend some time on. It's funny. I've had in my mind two conflicting thoughts, and that's very common as you get experienced in the business. And the one thought is that the economy is going to continue to do really, really well for the next 5 years because of the baby boomers, because of certain policies, because of a lot of different things. We can expect material strength at least for another 5 years before we get a lost decade, probably 10 years, 8 to 10 years. But at the same time, I'm in Orange County and I'm thinking about real estate here. And I continue to say this just feels bubblish. Like I feel like there's going to be a reset. And I'm saying to myself, well, how can this possibly be when we have a housing shortage of 3.8 million units? How are prices ever going to come down? And like part of me is, okay, The Chinese own 11% of the housing stock. Now that everything's going back up in China, they're going to get FOMO. They're going to stop pushing their money out of China, and the marginal buyer in Orange County and some of these cities around the country is going to evaporate. And when that evaporates, you hit an air pocket and you get a reset, and the economy can still be strong even if that resets. And that's part of the thesis. We're going to get to some policy things that may yield a booming economy and either consolidating home prices, meaning they can just run sideways for many years and not go up, or actually correcting home prices, but not correcting in a way where you wind up with a 2008 once in 100-year event, correcting in a way like it got ahead of itself because of COVID and some unnatural government intervention that needs to be flushed through, and the overall economy can continue to flourish. So that's where we see the industrial opportunity. Tech, again, these are going to bounce. There's a lot to do there. We've got a bunch of exposure. And then materials, this one, I think there's immense opportunities. We've got Albemarle. I think that's going to be a monster for us, relatively new position. And then NYSE is starting to bounce. These are kind of more the industrial names. Real estate bounced, pulling back a little bit. You're going to see the CCIs of the world and the REITs continue to rally. Bullish percent SPX. I think, I've said it on the media for the last week or so, and market probably bottomed a couple weeks ago, tried to go back and retest, didn't quite do it. I think we put the bottom in, and I'm super glad for the new people that have come in now that their money's getting to work right away, because I think we're going to be straight up to the summer, as I had said. And yes, I know we have April 2nd looming, so we'll keep some dry powder to put money to work if some crazy thing happens. But if you look at most of the stocks that are going to be affected by it, they've kind of, this is going to be the biggest known surprise in humanity. I think it's going to be the sell the rumor, buy the news scenario all over again. And most people think they have some edge, like tariffs are coming. Like, who the hell has not heard about that? Like, turn on your local news, Fox 5. You don't need to turn on Fox Business for that. All you need to do is have a heartbeat, and you know that that's coming, which means if everyone knows it, it's probably priced. And if you look at most of the industrial stocks and auto parts suppliers and everything else, a lot of that's priced. So when it actually happens, or if it happens, less than expected, there's only upside. Downside's kind of priced in, and that's our base case. And, you get the bears that'll all say, oh, the market's being too conservative. Maybe in the short term, maybe you get some short-term volatility, but that's not how we think about it. The businesses that we buy, and I always say you can't invest over things you have no control. So the businesses that we buy, the demand for the items and the competitive moats that they have are going to be unchanged, irrespective of how much of that gets passed through the consumer. There is a fixed amount of demand that's not going to go away. Now, could it hurt at the margins for a few weeks or a couple of quarters? Sure, but it's not going to change share, because their competitors are all going to have the same climate that they have to operate in. So therefore, it's a short-term reset for a long-term reward if you get the worst case scenario. And if you don't, then it's just massive money made to the upside overnight and no one gets let in. So, take your risk, like modest downside volatility because of a knee-jerk reaction in the short term, versus massive upside if it's slightly worse than expected, or it's known, and then the weakest hands that haven't been turning on the local news finally get flushed. We take their shares from them, and then we go straight up. So I think that's kind of the environment here. Here are a bunch of charts that we've some names that we've discussed over time. And what's so exciting and beautiful as we go through these is the window has closed. There's no question that this once in 100-year opportunity to put money to work is getting narrower and narrower as a lot of our names have taken off. But there's still such beautiful generational. And when I say generational, some of these are once in 20 years, but a lot of them are once in 10 or 15 years. And that's a lot of time to get, to be able to buy it at such amazing prices and get doubles, triples, quadruples over the next handful of years. And that window is pretty much closing. So I want to congratulate all the people who've come in the last just week and a half alone. And many of you have already been approved by Interactive Brokers. I don't know what they're doing over there, but they've got their act together, and these applications are getting approved in day or two versus a week, which is exciting and funded. So we're going to get money to work now, get money to work after April 2nd, and rock and roll. So, but you can see, I mean, yes, BABA, a lot of people miss that. I mean, it's going a lot higher. There's no question about it. But we're now up 120% off the lows. So, hopefully for those of you who don't have enough exposure, if you're lucky, you'll get, high 120s to get back in, maybe mid 120s, but don't hold your breath. The train has left the station. We told you that would be happening. That's already happened. All these other names that you guys are pessimistic on, they're next. So if you thought this was a surprise, which you shouldn't think it's a damn surprise because we spent 2 years telling you what was going to happen, just wait till you see the next batch and what's going to take place. And it's so funny. I had some new clients like, I've been listening to you for over a year. I thought I knew how you invested. I had no idea. I'm looking at the portfolio. He's like, I would have never figured this out. I was like, well, what else do you want me to tell you? You're a client now. It's a different game. So anyway, so Baxter, this is a defensive stock. They take a year and a half, 2 years to base every cycle. Here we are. And then it just goes straight up and it recaptures new highs. Why? Because it has a moat. The IV business, the switching costs are high. Their pumps are fantastic. And they got rid of the low quality business, the low growth business called the kidney business. And you can't give it away. And that's what happens right before they go to the room. Now, today on Cooper Standard, everyone's nervous about the tariffs. I pray to God we get a 15 handle because I really didn't want to put new clients in this thing at $17, even though it's going a lot higher over the next few years. So I pray to God we get some serious fear in the next week and I can get a 15, 14 handle on this and do one final absolute load the boat, but I don't think we're going to get it. So we'll see. Disney, I like here. I would put new money to work, but this is going to take a few years and it's going to work its way back to new highs and beyond. PayPal, or Generac rather. So look, you bought it in the 90s, rode up to 195. That's great. This is the beginning. This is the next phase. This is what it does. So if you look back to 2016, same exact thing. You get this panic sell-off, fountain, double check, then you rally up. Everyone gets excited, gets in at 195. You smoke them out. You drop 33%. And then you just start to move up to the next major move. So 3 years from now, this thing's going to be a ton higher. A lot of people probably got knocked out here. I would put new money to work here for sure, and probably will. Intel, Lip Bhutan, we're going to cover some of that today. This is going to be fantastic. That's all I can tell you. Small caps, final breather before the move higher. Banks, I think we're going to get another rally here. We'll probably lay off on the next rally. PayPal, same exact story. You come out of these lows, you get the checkbacks, scare everyone out, and then you take your next leg higher. This time, just like we saw with BABA, by the way. This is standard fare, ladies and gentlemen, because you just get the dumb money that come in right after you have the massive rallies. Then you take them all out, and then you take the next huge leg up. And then they'll buy up here at 160, take it back to 140 before you let them off the bus, and then you go straight to 200 plus, and that's the way the game works. So, all right, where were we? PayPal, this is a home run. This I'm putting new money to work for sure. Stanley Black & Decker, this is the most leveraged play on the housing recovery, which I'm going to tell you why is coming to a theater near you very quickly. I love this play. Bonds, head and shoulders bottom here, started to rally beginning of the year, will consolidate a little bit. They're going to continue to rally for the foreseeable future, which helps all of our theses, whether it be at home builders. And we talked about last week with what Scott Besson is doing on the capital charges for banks, removing some of those restrictions. Is going to lower the 10-year by another 30 basis points, takes it under 3, takes 10-year mortgages under 6, and you have not seen anything like a housing boom of what you're going to see over the next 5 years in terms of supply. So how do we want to play that? Again, do we want, just like the pent-up demand in cars, do we want to be the one fighting the war where these car companies, OEMs, are going to be fighting against each other for share and discounting and offering incentives? No, we want to be the arms dealer like Cooper Standard, selling a ceiling as they lower prices and volumes go through the roof with a 13.5-year average car on the road. Let them kill each other over price. We're going to sell them the weapons, which is the ceiling and the fluid transfer systems, and we get paid on volumes. It's going to be the same with the housing. The home builders are going to be producing tons and tons and tons of houses with all the new land available to build. And the ones that are going to benefit are going to be the home building supplies distributors and those type of businesses like QXO with Brad Jacobs, which we own, and had an opportunity to be able to participate in the early days. That is one that you just buy and you wake up in 8 years and you've got a 7 to 10 bagger. I mean, that's how Brad Jacob rolls. And the guy's a winner. He knows how to do accretive acquisitions. He knows how to add technology value add to drive profits, synergies, and then he knows how to play the multiple arbitrage game. So yes, he paid up for Beacon, but you can be sure his tuck-ins and acquisitions in a fragmented market, he's going to be able to buy at lower multiples and get the public market multiple arbitrage, and it's going to be fantastic. So excited for that. VF Corp, same exact story every single cycle, rallies off the lows, checks back, takes everyone off the bus, and then goes back onto new highs. Same thing here, rallies, makes everyone doubt it, and then back to new highs. So it takes a little while to consolidate. And Bracken Darrell is going to take this thing back up to new highs, and it's going to be, a handful of years, but off of a $13, $14, $15 basis, you're going to wind up with a 7-bagger. So, I mean, or you can just switch to the next shiny object and keep missing great opportunities. Biotech, same thing every cycle. You get this bottoming, another fake out like we had last year, then you rally up, fake them one last time, and then another parabolic move. So 130, 140 would not surprise me in a reasonable amount of time. Okay, chart of the week. Let's see where we are. I thought this was going to be a short one because we had them. By the way, if you missed the amazing interview with Jeff Edwards, CEO of Cooper Standard last week, be sure to check in either at our YouTube station, just go to YouTube and enter Hedge Fund Tips, or Hedge Fund Tips with Tom Hayes podcast episode 283 was phenomenal. So let's talk about CTA, positioning in U.S. equities. They got this low in the hole in 2022. They got this low in the COVID lows when we were pounding the table to buy in fall of 2023. All of these were great buying opportunities. They're down at these levels now. That's the reason we've been talking. This is very interesting. The road from the Plaza Accord to Mar-a-Lago, the dollar's approaching valuations hit in 1985. This is super important because this was Reagan's first year of second term, just like it's Trump's first year of second term. Dollar was weak. The dollar was record strong. They wanted it weak. And they met at the Plaza. It was named after the Plaza Hotel in New York City, which I think, oddly enough, I don't know if Trump owned it at that time. That's kind of funny. I think he owned it at that time. Anyway, they came to an agreement between France, West Germany, Japan, United Kingdom, and the United States to depreciate the U.S. dollar in relationship to the franc. the Deutschmark, the yen, and the British pound sterling by intervening in currency markets. The dollar depreciated significantly from the time of the agreement until it was replaced by the Louvre Accord in 1987. Some commentators believe the Plaza Accord contributed to, let me highlight this so you guys don't miss it, contributed to the Japanese asset price bubble of the late 1980s. Ladies and gentlemen, I'm going to step out on a limb here and say, if there are rumblings about a Mar-a-Lago Accord, okay, and there is obviously Trump has shown his hand that he wants a weaker dollar to give us an advantage with trade, with paying off the debt, with everything else that comes down to it. If they were to negotiate a Mar-a-Lago Accord and depreciate the US dollar, this would not contribute to a Japanese asset price bubble over the next 4 years. This would contribute to a Chinese asset price bubble of the late 2022s. And I think that all of the pieces of the puzzle are coming together, that this would not surprise me at all. And I think this could be the fuel for the last parabolic move in China before they come to 2-3 lost decades like the Japanese have due to demographic miscalculations that cannot be unwound in the next decade plus. So, and that would certainly cause the marginal bid in using U.S. housing, certainly in areas like Orange County, to evaporate and cause a major air pocket. Because if everything is going up around them, they're not going to pay the friction and the risk of getting additional money out of the country. They'll keep what they got out of China here because it's so hard to get it out. But when you've got more opportunity domestically and you got friction to get money out to a place where the opportunities are not as good in the short term, all you have to do is look at people's incentives and you know how they're going to act. But this is setting up very, very similarly. So keep an eye on the Mar-a-Lago Accord moving forward. Jack Ma-backed Ant touts AI breakthrough using Chinese chips. Jack Ma-backed Ant Group company used Chinese-made semiconductors to develop techniques for AI training models that would cut costs by 20%, according to people familiar with the matter. Ant used domestic chips, including from affiliate Alibaba Holding Group and Huawei, to train models using the so-called mixture of experts machine learning approach. The people said it got results similar to those from Nvidia Corp chips, like the H800, they said, asking not to be named as the information isn't public. Ladies and gentlemen, necessity is the mother of invention. That is big news. Alibaba stocks gains. Its AI chips could be gaining traction in China. China advisor urges boosting consumption to 70% of GDP by 2035. They want to be like the US, and what is the biggest toll taker of Chinese consumption for the middle and upper class? It's called Alibaba, Taobao, Tmall, etc. And we are poised to benefit from that. Alibaba launches new open source AI model for cost-effective AI agents. Chinese consumer companies signal spending is picking up again. Forget the Mag 7. The terrific 10 are the tech bet for 2025. What are notice the author is different when we're talking about China these days. The terrific 10 are Alibaba, Tencent, Meituan, Xiaomi, JD, NetEase, Baidu, BYD, Geely, and SMIC. China is back as Goldman and Morgan Stanley rush to re-rate with appetite at post-2021 high. You can't make this stuff up, ladies and gentlemen. After 100% rally, opinion follows trend, and they get to be right for the next year to 2 years as this thing goes parabolic. They'll get super duper excited when it's near its top, and we will be laying off into their upgrades. U.S. just as we were buying into their downgrades. U.S. adds export restrictions to more Chinese tech firms over security concerns, just make them more we're forcing them to do business away from us. and to learn how to do it themselves. And they've done it a lot sooner than we could have imagined. If we had kept them dependent on our chips, they would be a decade behind as we look out, but it is what it is. Trump ally visits Beijing to pave way for Xi summit. So Trump and Xi are going to meet. Intel CEO Lip-Bu Tan completes $25 million stock buy. And here's the beauty of it, ladies and gentlemen. He paid $25 million for 1,043,406 shares on March 26th. The price per share was $23.96. Most of you have bases well better than the CEO of the company, and you probably still have a very limited window to lock that in. Talk about aligned interest with a partner. Super exciting news. Bank of America mortgage applications jumped 80% in Q1, says the executive, which is kind of interesting when you think about consumer sentiment was in the gutter, et cetera. But you had a few weeks there where mortgage rates came down. Wait till they drop below 6, and this thing goes all in. This is what I'm talking about. Trump moves forward with plans to use federal land to build affordable housing. So, nationwide, the federal government owns about 1 million square miles of land, or about 27% of the country's total land area. The new initiative will focus on the roughly 500 million acres managed by the Department of the Interior, which oversees national parks and wildlife refuges. So, you will get not only a beautiful 1,800 square foot home by KB Homes, but an endangered elk in your backyard, free of charge. All right, joking, not joking. So here's the deal. This announcement follows a recent report from Realtor.com, which found that the industry has a housing supply gap of at least 3.8 million units. At the current pace of construction, it would take more than 7 years for supply to catch up with demand. In the joint op-ed in the Wall Street Journal, Burgum and Turner said that the interagency task force would work to reduce red tape associated with building on federal land and cut through the bureaucracy to spur new housing development. So what they're basically saying is that we've had so much trouble in municipalities because people don't want crowding in their own backyard that we're going to just open up this land and build. There's another aspect, because they really struggle in the suburbs more than they do in the cities. People don't move into the cities because they want to be by themselves. They move into the city because they want proximity, they want people around them, et cetera. There's another thing that they're going to do with some of the tax credits in the cities to force the local politicians to cut the red tape. So I think you're going to get greater density in the cities, and I think you're going to get greater density in the exurbs where these federal lands are, where they can build massive amounts of houses now that a lot of people can work hybrid and that type of thing. And businesses will pop up just like they did in the suburbs in the 80s. So we will open up portions of federal land for large-scale housing construction. These zones will be ultra-low tax, ultra-low regulation. We're going to open our country to building homes inexpensively so young people and other people can buy homes. So 2 things are going to happen. One, you get the Chinese marginal buyer in the expensive areas evaporating because there's more opportunities in the short term in China to make more money in a shorter amount of time. Number 2, you're going to get the opening of the federal land, 500 million acres, to build these 3.8 million. And number 3, is we're going to get to in just a minute, is basically here. The City Journal piece from Christopher Elmendorf and Alex Armlovich. And he said Trump ordered his departments on day 1 to deliver emergency price relief, including action to lower the cost of housing and expand the housing supply. So what they're proposing is housing is too expensive because its development is overregulated. Yet the regulations that drive up housing costs, arcane local zoning and building codes are not the kinds that congressional Republicans are best to fight. However, many of the local codes protect suburban single-family home neighborhoods, a residential ideal that Trump has pointedly defended. In a new paper, we suggest one way out of this dilemma. Target big, expensive cities for housing growth while letting states decide for themselves what to do about the suburbs. Specifically, we propose to reallocate federal affordable housing tax credits, a roughly $15 billion subsidy, away from the nation's biggest, most expensive cities unless they adopt a basic set of pro-housing reforms. Specifically, to retain their eligibility for the federal affordable housing subsidy, these cities would have to allow development of apartment and condo buildings along major corridors and in commercial areas, cap development fees at $10,000 per new unit, roughly the national average, provide waivers from price controls that render a project infeasible, and approve projects that conform to applicable standards ministerially, that is, without discretionary reviews and associated conditions of approval that may change a project's design or increase its cost. Congress should also task a federal agency with developing criteria for measuring cities' housing performance, such as housing stock growth relative to potential growth, given prices and parcel characteristics. Persistently poor performers should lose their eligibility for federal subsidies regardless of whether they have opted into the federal pro-housing reforms. Our proposal is budget neutral and state neutral. This is important. If a city like New York chooses not to relax its regulations, the tax credits it forgoes would flow to affordable housing projects elsewhere in the state. The new policy would put significant pressure on big city governments to develop pro-housing reforms, since progressive city council members won't want to be seen forfeiting affordable housing funds. The suburbs would be unaffected, however, as the new policy would apply only to big, expensive cities. So you basically bracket it. The suburbs, where everyone's NIMBY, not in my backyard, let them have what they want. You've got 500 million of federal lands. It's going to be all in massive production. And then now you force the cities into it, which really, really could be effective. And that's how I think we get a renewed affordability in housing in a relatively short period of time. So again, we've got to find some ways to play the arms dealers. And I think the number one company to start with, and I've got a lot more on my radar, is going to be QXO, okay, which we have a nice position from lower levels, and we are going to hopefully be able to use any opportunities to get more and set and forget for a long time, because he's going to be in the game in a major way and an effective way. So these are the articles you can see here. This shows where all the federal land is. Yellow is Bureau of Land Management. It's mostly in the West. Bureau of Indian Affairs, Department of Defense, Fish and Wildlife Service, Forest Service, et cetera, et cetera, et cetera. So this is where you're going to see huge amounts of construction in the West. Sales incentives on home deliveries as a percentage of revenue. They're going to continue to produce and build. They just don't know it yet. It's going to be a race to the bottom for their margins, and the building supply companies are going to make fortunes supplying the arms to the baddlers, which are going to be the KB Homes, the Lennars, et cetera. They'll make money, don't get me wrong. They're going to benefit from this as well, but I want to be on the other side of it. Japan inflation slows, but the uptrend backs the case for rate hikes. We've said this over and over. As a matter of fact, we posted on Twitter. It's kind of funny. Yesterday, they were all saying that the tariffs, the market's down because of the tariffs. And if you actually looked at the stock market, it was kind of funny. I had to post this, and I don't like commenting day to day. Must be about the auto tariffs. Meanwhile, The only stocks that were down were the Mag 7. Everything else in the market was up, and every single journalist on TV was saying it was the auto tariffs. This is all Trump's fault, and these were the stocks that were down. What was going on? The Japanese 10-year JGB yield was going to 20-year highs. And what we've talked about regularly for the last 6 months is to watch the unwind of the carry trade. As the cost-free money starts to have a cost, all the leverage that was embedded in the carry trade, shorting yen to get free currency to then put into the most crowded trades, which is Mag 7, is unwinding. And that is the day. But here's year to date. What's down? Only the Mag 7. So like people keep asking me, when's this going to stop? I was like, when's what going to stop? We're up. I mean, this has been an unbelievable year. So, and this is where most people are stuck. The passive indexers are getting slammed because they're overweight in all these names that have been hit the hardest. And they don't realize it has nothing to do with tariffs, has nothing to do with customer sentiment, has to do with the unwind of leverage that was embedded in the carry trade. So as the Japanese inflation continues to pick up, they will have to raise, the carry trade unwinds, all that hot money comes out of the hottest, most crowded trades, and you see more of this. I think we're probably through another phase of this, and these are going to get a bounce, but every day when you see the market down, just go look at 10-year JGBs, and that'll tell you the answer. And all the commentators can, blame policies that are unrelated to the stocks that are actually down. Jack Ma backed Ant touts AI breakthrough using Chinese chips. Alibaba stock gains. Oh, we're okay. Here we go. We got so much to cover. I thought this was going to be an easy one today, ladies and gentlemen. We got a lot to cover here. So this is kind of what's happening with cars. Smaller cars and smaller houses are going to be the name of the game for the next 5 years, which is going to lead to massive volumes, which is going to help Cooper Standard, which is a OEM supplier, and the building suppliers, which are OEM suppliers. I guess Lennar and KB and Toll are considered OEMs in the housing business. So what you're seeing is some of the compact SUVs are going up, the subcompact, the compact cars, the mid-sized trucks, and everything going down. Fixed housing affordability index. Housing has not been this unaffordable since 2006, 2007. So how does that get resolved? Last time it was through deleveraging and HELOCs coming due and a big crash. This time it's going to be more and more options becoming available. And once you have a massive supply of options, prices come down. And you're going to see the same thing for labor as well. I ran an ad for a personal assistant. I can't even tell you, I need an assistant to go through all the applications I got for an assistant. I mean, you can't make this stuff up. It's staggering now. So the shift is, so what I'm saying is wage inflation is coming down, which we all know. Why? Because there's a greater supply of labor than demand for labor right now. And the same is going to happen as the supply picks up on federal land and in cities through the coercion tactics that I discussed. And this will finish. Now, national home prices change. I am a master of patterns, and I can tell you this pattern is pretty obvious, ladies and gentlemen. Here is the national home price changes. And just for simplicity, let's use real versus nominal prices. And what you can see is the first part of the 20th century, it just went back and forth pretty regularly. That was before the 30-year mortgage, by the way. Then the 18s to the 30s, same thing. And then post-World War II, this is when the game got interesting. So you'd have 3 to 5 years of growth, followed by 3 to 5 years of contraction, 3 to 5 years of growth, 3 to 5 years of contraction, and more back and forth every 3 to 5 years. growth contraction. You had massive contraction. People forget in real terms from 1989 to 1996. That was the last Orange County housing crisis, which was caused by the Japanese hot flows coming out after the China market peaked. So that's kind of an interesting parallel. 97 through 2004, and then 2006 to 2011, contraction, then expansions basically since 2012, straight up till now. That's one of the longest runs post World War II. It actually is, barring 97 to 2006 was a pretty long run. 2, 3, 4, 5, 6, 7, 8, 9. Here we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Then you had 1 year negative in 2022. Last 2 years have been flat. So this is an extreme is what I'm trying to tell you. And then what the case that I was making was how could you be generally constructive on the economy, even though I see international stocks outperforming domestic, but I'm still constructive on the economy because of the baby boom demographic, et cetera else, and yet think housing prices are going to compress in certain areas or in aggregate. And I think, there are similar examples. In the early 90s, you had, booms in new technologies and general stock market, but you really had some housing and banking crises from just overheating through this period of 83 to 88 that needed to consolidate. And I think that's probably a pretty interesting parallel to consider. Home prices versus inflation. Here's home price appreciation has dramatically exceeded inflation. This runs in cycles. It underperformed in the 30s and 40s, outperformed in the 60s, and has outperformed last few years. This will converge, and I think for some of the reasons that I'm talking about. Real home price appreciation adjusted for inflation, going all the way to 2024. So you can see this has been a really aggressive move. None seen like this since the 2006 peak. This is only showing to 2022. It's funny. I look at TikTok and I see all these trends. In 2022, you literally couldn't get to your feed. Every schmuck was making a fortune in real estate and selling courses on how to make money in real estate, et cetera, et cetera, et cetera. And that's what you see in extreme. So U.S. median housing payment as a percentage of median income, again, highest since 2006. Again, not calling for that type of crash, but I think the early 90s is a really, really good parallel in terms of housing prices declining and disruption in the housing market, price-wise, not supply-wise, while the economy and the stock market does well. And international stocks do extremely well. United States, 57% affordability gap, income needed to buy versus actual. So this is all from Charlie Bilello. You can see some of these major cities starting to come down. Tampa, or grow at slower paces. I think you're going to see more of those hit the list. Increase over the last 5 years. Average hourly earnings have grown 25%. U.S. home prices have grown 53%. These will converge. I'm a mean reversion guy. U.S. home price growth by decade. This is mind-boggling. So real annualized, the highest decade was 40 through 49, followed by 2010 to 2019, and 2020 to 2024 is double the highest, basically at 4.6. The average for the last 133 years has been 0.5% per year, real. Part of the reason for that is the American homes have doubled in size. So this is another theme. I think we're going to be going to massive increase in volume of cars and houses, massive reduction in size in both cars and houses, because we're meeting the needs of the people who need it, which are people starting families, not people in their mid to late 40s, early 50s who want to upgrade to the big house to be the biggest on the block etc. So that'll be the next phase. Moving along, all bear markets start with a correction, but not all corrections turn into a bear. I think that is the case this time. That's Ryan Dietrich stuff over at Carson. Investor allocation to equities at an all-time high. That's why you had to have some give back here in the first quarter. And continued underperformance for Mag 7, even if they technically bounce from here, which they probably will. Money market funds now at 10 trillion. So there is a lot of dry powder ready to be deployed. I think a lot of that's going to start to be allocated by the financial advisors into internationals after internationals had a big move. That'll be the next phase. Here is long short funds. Percentage short, they always sell at the bottom in the hole. They were record sellers at the exact bottom in February. Now they're going to have to chase up in coming months. Biggest foreign selling of U.S. stocks since March of 2023. So again, selling in the hole. Prices, this is from Manheim and Cox. Prices of cars, ATP is coming down. This is in line with our thesis. Let them fight the war, lower prices, increase incentives, increase volume. Their margins will collapse. Our volumes and margins will improve because we have economies of scale through the operating leverage of the business. Relationship between valuation and forward returns. Equities trade near smallest risk premium since 2002. A lot of parallels to 2002. What outperformed? International small cap value. We're starting to see that small cap is lagged. If you don't have enough small cap, now's the time, in our opinion. We've raised our Euro area GDP forecast by 1%. Opinion follows trend. Europe has outperformed. So now all the strategists are catching up. Market implied Fed funds rate. So anticipating $369 by the end of the year. Energy consolidating, markets approaching a key crossroads. What do we have here? Okay, one of the sharpest drawdowns, whether you get a recession or not, and the outcome. I think this is sans recession, which means we're going to recover into summer. Next year will be a bit choppier, which will create more opportunities. We'll probably be harvesting. I would think we're going to probably be harvesting about a third of our positions by the end of this year, or maybe first quarter of next year, raise a bunch of cash, and then next year gets choppy, a midterm year, and we'll be able to put a lot of that cash. And we'll probably be able to start the year with some nice put spreads across different sectors and companies, make some money on the downside, and then redeploy for the next 5 years and have an awesome time. Large deals announced since 2018. So that's been anemic. That's going to come back quickly. Inflow into Chinese security rises to record high. Opinion follows trend. Growth impact of credit impulse in China just beginning, ladies and gentlemen. No one's been paying attention for the last 3 quarters. We've been pounding the table. Upcoming upcycle in consumer credit growth. Lending standards for consumer growth. Okay, so lending standards for consumer loans have been going down. The other thing is there's a lot of equity in houses. As rates come down, people are going to use that as the piggy bank again, like we saw almost 20 years ago. That's going to be very good for the general economy. Small caps positioning, everyone's underweight. It's been time to buy when newsletters sell. So not only are the hedge funds selling in the hole, the newsletters are all bearish. That's usually what you see at bottoms. This was the only failed signal in early 2022. So now everyone's pulling out their 2022 charts. Why? Because of recency bias. So they look at the most recent experience that they've all went through, and the 10-year-old money managers think that's the only one. So they're all looking for this to go a lot further. I don't think they're going to be right in this case. US dollar and equities rarely fall sharply in tandem for long stretches. S&P US dollar index. Last time it happened was 22 2002. Again, another parallel. We've always talked about 2001, 2002, which was the time to position where? International small cap value. Everything no one wants. And now they're starting to want it after they're up a lot, but the game is actually just beginning. Asset return expectations. Oh, that's funny. Everyone expects Japan to have the highest returns. I think the opposite is going to be true. Speculators turned short dollar first time since October, so opinion is following trend as the dollar's weakened. That can be the beginning of a very long weakening cycle. Plaza Accord style, Mar-a-Lago Accord style. S&P returns following large declines in U.S. sentiment indicator. We covered this, 6 and 12 months out, you're up double digits if there's no recession. We believe that is going to be the case this year. Dot-com boom was way more extreme. I think this is kind of interesting here, showing the parallel. A lot of people use analogs, but we could be in the early 90s stage, which would also be very interesting. So it's something to put it in perspective when everyone says we're going to crash. I think you're going to see those bounce. Now, not the only game in town. International starting to outperform. Country composition of the MSCI All Country World Index we've covered before. United States is 64% of the weight. It's not 64% of the earnings power. So expect these weights to start to, of course, they were taking down China exposure just as the earnings start to accelerate. So this reminds me a lot of, actually go back and listen to the podcast in 2020 during COVID. I think the energy sector had gotten down to 2% of the weighting of the S&P 500, down from like 10%. And I said, this is not sustainable. And if you remember, they were basically threatening pensions and money managers. If you invested in energy, you'd be canceled effectively. And so no one would do it. And I said, look, at the end of the day, people want their lights on. So it's a question of how much pain they're going to take before they all flip. And that's exactly what happened. The same thing is going to happen with China now. You've dramatically underperformed this year if you had no international exposure. If you were overweight international, you are doing extremely well and smiling so wide you could eat a banana sideways. So that's that. And so expect these weights to go up, this weight to come down. Policy uncertainty weighing on U.S. exceptionalism. Okay. Again, these are people looking at policy when they should be looking at the 10-year JGB. S&P performance has historically rebounded well following corrections. So this is from BMO Capital Markets, actually shows greater returns than we were talking about, but the key is 12 months out, double-digit returns if no recession. We are in that camp, double-digit returns off the low, which could mean, again, what we had anticipated for the year, high single digits overall year returns for the passive indexers in the S&P 500, which means S&P 500 underperforms, which means stock pickers win the day who are good at it. China consumption picks up at year start in line with thesis. Euro USD redux the significance of whatever it takes. Euro is starting to rally. No one's paying attention. I also love the rally in Boeing that no one's paying attention to now. That's pretty exciting to me. I love when stocks start to rally and people aren't paying attention because they got so pessimistic at the lows. It reminds me when we were talking about GE at the lows and you couldn't give it away. And that thing had a monster rally with no one paying attention. China's fiscal stimulus in 2025 will be the largest outside the pandemic. That's big news. No one's paying attention to it. This would be the most pension and target date this would be the most pension and target date fund buying since March of 2020. Okay, so they rebalance, they get triggered on the basis of drawdowns. All that money is flowing in over the next few weeks. So pay attention to that. Target date funds. And for those of you who have already been approved, congratulations. Who are already in and funded, we're putting money to work and we'll put the rest to work next week as well. And those of you who want to come in this opening, do get your inquiries in, because it does take about a week to get all the paperwork done and approved and funded, and we can start allocating so you can take advantage of these opportunities we're discussing. Chinese EVs are making inroads around the world. Here is, this is from Seth Golden. This is an S&P chart. So we see this correction here, and then a rally, and then check back. Like a lot of stocks, rally, check back. Here's the check back that we're going through right now. So this looks pretty regular. Conference Board 1 year expectation of stock prices has collapsed. Biggest decline ever in 40 years. The other big declines were COVID, COVID lows, 2002. So that's an interesting stat from Fundstrat. May soon lose its U.S. may soon lose its global stock market leadership crown. We've been talking about that and preparing for a while. It's not because U.S. is going to lose their exceptionalism. U.S. is going to do great. I think what's going to happen is what happened under Trump 1.0, which is that the middle and lower class are going to improve more than the upper class under Trump second term. So the stock market returns will be more subdued in the US. They will dramatically outperform in international, and they will dramatically outperform for stock pickers buying those stocks that do well when Trump is in office, and avoiding those stocks that have already done well in the rearview mirror. And we do concur. Here's another situation here, looking at the trade weighted dollar index. I really like this chart because it talks about when the dollar weakens, these different regimes. Regime 1, dollar weakened, you had you had international outperformance. Then the dollar strengthened in Reagan's first term, weakened in the second term. That was the Plaza Accord peak that we talked about. Then you had dramatic international equity outperformance. And what they're talking about here, you can see, international equities during that period up 17%. Then you see regime 5, the dollar weakened from 2003 to 2009. You had dramatic international outperformance, 14% compounded per year versus 5% of US. Then you had the dollar strengthening following 2009. And what they're talking about here is dollar now weakening, and you're seeing the international outperform the US, and these things go on for at least a handful of years. So more stuff. We burden ourselves with the facts. Let's see here. Okay, from Sarah Eisen, here's the chart on the global imbalance that the Trump administration is trying to adjust. US makes up 29% of global consumption, but only 15% of global manufacturing. China makes up 12% of global consumer spending and 32% of global manufacturing. We have lost a lot of manufacturing share to China. Well, guess what? China wants to increase their share of global consumer spending while we want to increase our share of global manufacturing. So maybe there's a deal to be done there, and it comes with a reset and a reval of the US dollar to make us more competitive globally. They get what they want, we get what we want, and how's that for reciprocal? So the meeting is imminent. US durable goods orders, motor vehicles and parts are up. Front loading ahead of tariffs boost U.S. durable goods orders. So a lot of loaded production should help Cooper Standard in Q1, which is pretty exciting. And Jeff Edwards alluded to as much on the interview we did last week. Growth expectations, U.S. has peaked while the Euro area is too low, according to MRB Partners. Here is the 10-year JGB. You can see what's happening with these yields. You can see why the carry trade is unwinding. Here is U.S. sales for each OEM by origin of production. So we'll see how this shakes out. But as Jeff Edwards said on the earnings call, the OEMs are going to have to take it. The OEMs basically pushed all the part suppliers down to Mexico because they wanted to increase their margins. So they're going to have to eat that if they want the supplies they need to build their cars, which they're going to need because competition is coming and they don't want to lose more and more share. So they're going to run incentives. They're going to run volumes in order to not to lose share, which cannot be easily reversed. Magnificent Seven set for worst quarter since 2022. No one's bingo card other than the loyal, amazing listeners of Hedge Fund Tips with Tom Hayes. Here is the GDP now estimate from the Atlanta Fed, actually coming in at negative 1.7. There's a lot of inventory noise in this, so I think I don't know that you're going to get an actual negative print for Q1. These are often wrong, but even if you do, you won't get two in a row because of the way the noise in the numbers here, but it's something to keep an eye on for sure. Okay, moving along. Boeing wins next generation jet fighter contract. Boeing goes for second defense wins, for two defense wins in a row with Navy jet fighter. Advanced Auto Parts completes mass closures and plans to open over 100 new stores. So the plan is going as advertised by Shane O'Kelly, who ran HD Supply, $7 billion business for Home Depot. He shut down all the loser stores that were spread out on the West Coast that weren't making money. He's adding to those markets where he's number one and can do the hub and spoke model and mint money to the bottom line. Quickest products, good price, knowledgeable salespeople in the store, blended box, rock and roll. Now they've gone from contraction, fixing, turning the ship. Now they're back to expansion, and no one's paying attention or talking about it, which is when we love to be owners. Americans are choosing smaller vehicles. That is correct. Car makers rush to ship vehicles to U.S. ahead of new round of April tariffs. What's that going to do, ladies and gentlemen? It's going to put tons of cars on the lot, which is going to do what? Is going to force them to offer incentives, which is going to get more people buying cars, which is going to get more people keeping up the Jones wanting to have new cars as well, which is going to get some of these 13-year-old cars off the road, and it's going to start the benevolent cycle. Malevolent in terms of margins for the OEMs, benevolent in terms of volumes for the arms dealers like Cooper Standard. Retailers bulk up inventories to blunt tariff impact. Dollar weakness becomes profit boon for U.S. multinationals. Intel stock could soar if this Nvidia rumor is true. And here is the rumor. The Intel 18A process node, which features multiple technical innovations and should challenge market leader TSMC in terms of performance and efficiency, is ready for production, ladies and gentlemen. The challenge now is to scale up and fill that capacity with new customer orders. According to UBS analyst Timothy Arcuri, Intel is closing in on scoring Nvidia as a foundry customer, while Intel has both Microsoft and Amazon on board as Intel 18A customers. Winning over the largest fabless chip designer by revenue would be an enormous vote of confidence in Intel's foundry business. The rumor makes sense. The two are compelling reasons why Nvidia may be keen on shifting some production away from TSMC to Intel. First, the company is struggling to provide enough gaming GPUs to meet demand. Nvidia recently launched its RTX 50 series graphic cards, but supply has been extremely tight, leading to prices well above MSRP. Nvidia makes a lot more money selling data center GPUs aimed at AI workloads than it does from gaming GPUs, so it makes sense that AI chips would be the priority. Nvidia only has so much manufacturing capacity at TSMC, and the company would be leaving money on the table if it didn't go all out to meet soaring demand for AI accelerators. If Nvidia were to shift gaming GPU production to Intel while leaving AI chip production at TSMC, the company would likely have an easier time meeting demand for both products. The longer it takes Nvidia to meet demand from gamers, the more likely it becomes that those gamers give up and move over to GPUs from AMD. AMD's latest RX 9000 graphics cards are impressive, and Nvidia may be losing market share thanks to a rough supply situation. So Intel is the only game in town to solve their problem. They can make them an offer they can't refuse. Crown Castle fires CEO after selling business segments. That's good news, not bad news. They've now got money to buy back stocks, pay down debt, and that's why the stock is going up. Can healthcare stocks keep outperforming the market? We know the answer to that because we were the only ones telling you to buy healthcare and materials, which were the worst performers in 2024. Into 2025, they would be the best, and that's exactly what we've seen in healthcare, and materials will soon follow. Article of the week, real quick. This is one you definitely want to read at hedgefundtips.com. It's funny. It's called Times They Are a Change in Stock Market and Sentiment Results. I had a client and friend call and say, I didn't know you were into Bob Dylan. And I said, neither did I. What are you talking about? And they're like, your article has a Bob Dylan reference in it. I said, oh, yeah. So kudos to Jeff for pulling that together. All I care about is the content, not the style, and the content is phenomenal. He's talking about the Boeing update and all the turnarounds that Kelly Ortberg has brought to bear, and how sentiment is starting to shift from pessimism to optimism and from losses to wins. And you want to go through this Q&A word for word, because when you see what's happening, you're going to realize why we've been pounding the table on Boeing for so long. Whether it was at 138 or 150, this thing is just getting started, and free cash flow is now starting to gush in 2025, and it will be getting back to, as Kelly Ortberg said, previous levels in 2018 when the stock was $400, revenues were $101 billion, earnings per share 17.85, free cash flow $13.6 billion. Returning to financials like that means much more than just a double from current levels. The times they are a changing. I like how he tied that all together. Alibaba update about the chips. You definitely want to take advantage of reading that and all the work that goes into that. So that's that. Quick congratulations to all the new clients that came in last year and first quarter of this year. You could not be better positioned. Well, you've already seen it already this year, and that's just beginning for what we believe will continue to be a highly rewarding year in 2025. This view is based on what has already taken place in 2025, as well as much of the data we've shared in recent weeks on our podcast VideoCast, coupled with our proprietary methods of expressing and executing upon those views on your behalf. We will reopen to smaller accounts, $1 million plus, again, starting April 1st. But as we said, for those of you who listen to the podcast, you could start to inquire in the last week or two, and you can continue to do that, which gave a lot of people a jump start. So kudos to them. Congratulations to all of you I had the pleasure to speaking with and onboarding last week when we opened up the queue for inquiry. Several of you have already had your applications approved by IB so that we can begin deploying capital on your behalf imminently. To see if you qualify and take advantage of this opening, click here. That's at hedgefundtips.com. Larger accounts, the $5 and $10 million accounts, you're not limited to the once a quarter openings. You can come on anytime you want, but for the reasons that we discussed in this call, you can kind of see that you can wait, but the opportunity set's going to be a little bit different. There will always be things to do. There will be things that are down and out that we can take advantage of, but it's been beautiful getting money to work after this once in 100-year event created such unique opportunities in the market for sure. And they can access bespoke service at their preference. So the $1 million accounts, if you're coming in this quarter, you want to get in the queue now so we can get you approved, get you funded, and take advantage. The $5 and $10 million accounts, you want to get in now, not because it's the opening, you guys can come in whenever you want, but because of the opportunity set in our view. Opinion, not advice, see terms. Healthcare earnings, top 30 weights in the last 60 days. Earnings estimates have come down modestly. That's a function of sandbagger season. They take earnings estimates down every single quarter every single year in the first quarter, and then they build them back up. Financials are actually flat to up this year, down 25 basis points. Next year up 95 basis points. Economic data, nothing huge here that we need to spend a lot of time on. Estimates probably, again, right around 271. So they were at 275, came down to 271. That's normal. These will start to come up, and they haven't taken down 2026, so it's still back end loaded as always. Okay, so these are the 8 names I have for the hats. If I said that you are a winner in the comments of last week's VideoCast on YouTube and you did not send in your email address, there are 2 of you. You need to send in your mailing address, your physical and mailing address, so we can get you the Burden Yourself with the Facts Great Hill Capital hat that you won for commenting on the Jeff Edwards video. Go to hedgefundtips.com, click on contact, send me your mailing address. So far, we have Alan Woolman, Adam Dyer, Kyle McHugh, Ronnie Singh, Cole Ketterling, Peter McSherry, Gia Chang, Mitch Lim. And when you get your hats, we ask that you send a picture with your new hat on, and we will show you on the podcast if you desire. So those 2 people who won and didn't send in your mailing addresses, do that so we can get all these out at once. All right, podcast is over. Now we're going to stick around for extra credit with the Ask Me Anything questions from our audience. And we've got a bunch of good ones this week, so let's get the party started. And we've got Henry Griffin, the Wall Street Journal article on U.S. economic growth transitioning from oil towards electricity is huge for Albemarle. This switch will create large investments in grid scales and other forms of electric containment distribution in which lithium and lithium-ion batteries dominate. LFG, baby. Also, what rap do you listen to? Was listening to an old podcast and you mentioned how your Jersey roots instilled rap in you. I don't remember that. I don't listen to much rap. I'm a country guy. I like a good rap song, but Jay-Z was good in the day. I mean, look, Kanye was amazing in the day until he became an anti-Semite, but his music was really good. So I'll leave it at that. But, kind of sad what's happened to him. But anyway, Deep Value Investor. Hey, Tom, great podcast. Been following you since your 30-minute podcast, and now they're over 2 hours. Great work. I have a small cap I'm watching. Vient Technology, ticker DSP, undervalued. Double-digit growth, profitable cash flow. Thoughts on this? And second question, any concern with Etsy single-digit slow growth? No. They're in their trough. They're generating huge amounts of cash. If they continue to grow slow, they'll just buy in a ton of the company. But more likely than not, you're seeing the new platforms having high growth rates. They'll figure it out. And until they figure it out, they'll just give me bigger and bigger slices of the pie with no new money out of pocket by reducing the float. So DSP. Yeah, I mean, if you've listened for a while, so it looks like their cash flow is starting to roll over. Got to figure out if that's temporary or permanent or a cyclical thing. Let's see what they do. Chances are this is a company I would avoid because I can have no edge on whether they're provide Viant AI, a suite of AI intelligence products, blah, 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 digital and personal identifiers, blah, blah, blah. Video level data to power plant. So just tell me why they have a moat. I mean, so that's why Buffett generally avoids software companies. It's why we do. It's because the barriers to entry, number one, it's tough to really get one that stands out. And number two, once you do, the barrier to entries can be pretty low and you can be disintermediated pretty quickly. So I don't have an edge here, but if you have an edge as to why their stuff is the best in class and no one can ever compete with them, then you can start to take a look at it and try to understand why their cash flow is starting to decelerate so abruptly. And for us, that's just a pass. That goes in the too hard box. Doesn't mean the price won't go up, but it's not for us. Dustin Dickerson. Now that more information has come to light about CPS and its future prospects, would you ever think about increasing your initial underwriting intrinsic value price? Or is this something you determine in the beginning and don't change in order to stay grounded? Just curious, across the board with all investments you make, do you ever reconsider intrinsic value and therefore exit price when additional positive information shows up? Yeah, I've said many times that, we can adjust based on new information, up or down, but on balance, I'm probably taking some off at where I intended, which I didn't publicly disclose at all. So all I can say is it's a ton higher from here. So and probably meaningful amount of time from here. But this one's going to be a fantastic one for us. So no, I generally don't give credit for the whipped cream. There's a lot of new whipped cream that's come to light, but the story was so attractive even without that. Underwriting it on ICEs, underwriting it on zero to the rest of the world. Underwriting it on the cost base they had in place in 2022, not the revised cost base. So yeah, but we don't get in or out of our positions all at once. So we could have tranches of our investment that stay on for 2 times what we thought we would get out, and maybe 80% of our initial position could be out at or where we determined we would get out before we got in. And then the 20 we just hold as a flyer because it's up, 7, 10x, and it's just a free ride at that point. And even if it falls in half, we take it off and it's all free money, and we don't worry about it. But that's that. Don Gaffney. Question is, given the average age of the vehicle, 14 years old, a record high, increase population 40%, what is the amount of vehicles that have been taken off the road, as in how many have been sent to the junkyard and sent to be scrapped? Because anecdotally, I'll look from, I don't do any anecdotally, period. Okay, but here's what he says. Anecdotally, I look from my office, Schoolcraft College, and I can see the CPS headquarters at the traffic and don't see any old rusted out junkers with bad mufflers. Could it be that the car that are being built today are better than in the past, have a longer expiration, maybe 20 or more years? If so, production would be lower. Yeah, look, they'll run 20 years. The question is, do you want to be in a 20-year-old clunker? I mean, these, in Cuba, they run them for 80 years. But the point is when they become affordable, and it's like Generac, okay? The areas where they have the highest growth are the areas that they have the highest concentration. So it's keeping up with the Jones. It's when the power goes out and you're the only schmuck sitting in the dark with no internet and no and all your food going rotten, and all your neighbors are up and running and you hear the beautiful hum of their Generac generator in the neighborhood. It's the last time that's happening to you, and you call them up and you plunk down your $25,000, or you finance it as rates come down, and the game is on. So the areas that have double-digit penetration, like Michigan and Texas, where they have a lot of grid failures, Generac is growing at the fastest pace, and it just builds on itself. And the areas, once you start to see the affordability, the average total price come down, which is starting to happen, and the incentives going up, which has been happening, your neighbors are going to be getting new cars, and you don't want to be the only schmuck on your block with a 20-year-old car. And then the whole game resets, and we see this every handful of years. And you don't have to look back much further than 2017, and you don't have to look back much further than that than 2006, 2007. Every schmo had a new car, and that same thing is going to happen right now. So that's that. And yes, the cars are built better. But they just wear out. Even if they run, the style, everything just starts to get tired. Tom, if you're ever in the neighborhood and visiting CPS, I'd happily pick you up at the airport. If I don't win a hat, maybe someday I'll be a client. And on your Christmas list, VF Corp being an Irish, a green pair of shoes would come in handy. Don Gaffney. I love it, Don. There you go. I'll buy you a Guinness. All right. Rob Kress. Have you continued buying the dip in advanced auto parts at these prices? I think a better way to frame that is as new clients' money is being put to work, is advanced auto parts in the mix? And the answer is yes. Bill Sherman, what do you think about Novo at these levels? My gracious, how right were you not to jump in during the weight loss craze? I don't even have to look at it, Bill. You're now jumping on a broken growth stock with a ton of competition, which is what I said would happen. So yeah, it's down 50%. I think it's going to take 2 to 3 years. If it's going to bottom here in the 70s to 50s, it's going to take 2 to 3 years. My guess is it's 2 to 3 years more, and it bottoms 10 to 20 points lower. And I'm willing to be wrong and miss it. So that's what we call a broken growth stock. All the people that couldn't get enough at 147 are totally screwed, and rebuilding those institutional holders that got smashed is going to take a long time. That is a broken growth stock, ladies and gentlemen. Heather Christensen, AMA, take a look at C&M. Great tailwinds for the industry. Looks to be priced well. Okay, C&M. Core and Main. So again, this is one of these broken stocks that with recency bias, you say, well, it was 55, now it's 45. What a bargain. But where were you at $20? You know, I mean, that's the discipline you have to start to get. I have these sell side guys sending me these stupid ideas all the time after they're up 3x. And it's like, where the hell were you when no one wanted it? I'm not interested. Core and Main distributes water, wastewater, storm drainage, protects related service, underground water infrastructure. CNM. Cash flow is eroding. Price hasn't eroded commensurate with the deterioration in cash flow. So tell me how they're going to turn this back around, and I'll take another look. But for now, it just looks like you missed it. Tim D. Thoughts on ANF trading at 7 times earnings? Stop asking 2 questions per thing. It's selfish because it crowds out other people. ANF. I just don't like these. I've never, ANF is like the biggest, this thing has historically been a piece of garbage. Okay. So maybe they had some hot thing during 2022 to 2024. It's going to go back to being garbage. This is the definition of a broken growth stock. I want nothing to do with this thing. Could trade at 1 times earnings. I have no interest in that. UPS, I'm interested in, but it's not been beaten down enough yet for me to get super interested. So it's probably at a decent area. I mean, let's take a look at the financials, but there's not enough margin of safety for me to get excited yet. Probably bounces for a technical trade short term, but long term to get my double and triple, I just don't see it happening. So for me, it's a pass. It's probably okay if you're thinking in terms of 10 years. If you're thinking in terms of 3 years, it's a coin flip. Griffin Brown, going off my question last week, when do you look through a company's annual report? When you look through a company's annual report, do you read every word of every section, or are there certain sections you tend to focus on more than others? I assume this changes from company to company and industry to industry, but in general, what are the highlights? Well, obviously the financials come first, but beyond that, yes, I do read every single, especially the footnotes. That's where they try to hide all the stuff that's the most important. So yeah, you got to do the work. Lee Foster, I know you're a single name guy, but I was wondering if you ever invested in national ETFs. I'm reading contrarian national ETFs, blah, blah, blah. I'm looking at Vietnam and Brazil, specifically wondering your thoughts. Well, Brazil has a problem that we don't tend to do that. Brazil has a leadership problem. It's run by a socialist. Kind of funny coming from a guy who's got his biggest position with a communist country, but you know, if you can't take a joke. I think you're going to be right with that. And I think you're probably going to be right with Vietnam as well. But, you know, that's like, if you're super right with Vietnam, you make like 70, 80%, which is not enough for me to initiate a position. Like if I don't have at least a double, I don't even allocate capital. Brazil, you really need that guy out, hopefully sooner rather than later, to get the boom. But I think all of international is going to do well, so I don't think those would hurt you. Vincent Sentmore, would love to hear your opinion on Heist or Yale. Probably not yet, my man. What do these guys do? Services, a line of trucks, attachments, aftermarket parts. Yeah. The only thing worse than car parts is truck parts. I would say maybe ready, but I think I don't know. I honestly, with this thing, I would be looking at, I'd probably just set an alert at like $35. And if it hit, I'd start doing work on it, because it's just such a shitty business that it just has to be left for dead. And then I have to say, okay, they're not going bankrupt. Let me see how they compete competitively. It's just, there's not enough margin of safety for this quality of a business. I mean, at $5 with Cooper Standard, if they didn't go bankrupt, I knew I had a triple. And then from there, as they've improved the business, I know it's going to be a lot more, probably from $5, 15, 25 times. So Matt Mitchell, thoughts on T Rowe at these levels? High quality business, 2/3 of the firm's assets held in retirement accounts. Stick your asset base. I don't like the business. I think you're right, but I don't like this business enough to get involved. I mean, this is just a hope that they buy in all the stock and you own a bigger portion of the company. It's probably going to be okay, Matt, but it's not a great business. Matt Jack Tritnick from who knows where. Here we go. Longtime listener, big fan of your work, writing in from Slovenia. I'm sure you've heard of Luka Doncic, number 77, and your first lady to help put Slovenia on the map. First, let me say how much I appreciate everything you do and share with us. Your content is insightful, educational, and genuinely helpful. I especially look forward to your weekly podcast. My Friday mornings wouldn't be the same without it. Thank you for that. Since I started following you back in 2023, my entire view on investing has shifted. Currently, I'm managing my portfolios myself, as I truly enjoy doing that. But at the same time, I've been seriously considering having my money managed professionally in the future. Summer, my wife and family will be traveling to California. All right, whatever. Separate note. Curious about your take on Pitney Bowes. This is a garbage business. That's going to be a low price stock for a long time. And you missed it. I mean, if you're playing a turnaround, you missed it. Hard pass. Thanks for all you do. Well, thank you from Slovenia. Very excited. When you're in California, look me up, and we'll get together. Jacob Saxtoft, last week's podcast, you mentioned about banks' supplementary leverage ratio. Scott Bessent, how significant of a removal? We told you last week, Jacob, it's 30 basis points on the 10-year Treasury. Drew Robinson, what are your thoughts on Lyft? There's some activist involvement. It's probably okay, but I don't like the business. YFT. Next, Lucas. What price would you consider Nike undervalued? In this range, but it's going to take a longer time than most people think. So the question is, what's your IRR 5 years out? Oz Smaja, thank you so much for your product. I can't express how valuable your insights and values are. Okay, you're welcome. Thank you, Oz. I'd love to hear your thoughts on Puma. I don't know. No one wears Pumas in the U.S. other than that guy who, that golfer. His name slips my mind. Puma. I don't know. Puma is like that must be like a European thing. No one wears that in America. Let me see the balance sheet. I think you're probably going to be right on this one. I mean, I'd rather buy Nike and just wait 5 years for it to work than buy this thing. So they've been eroding cash. Let's see, how much debt do they have? Oh, debt's not bad either. Yeah, they generate a lot of cash flow. I think you're probably okay here. Certainly good enough for a bounce, that's for sure. Thanks for your amazing content. I'm an asset manager in Colombia and Brazil. Read vehicles. Decreasing. Da, da, da. Patria. PAX. Yeah, you really just have to know the underlying assets, and I'm going to have no edge on the buildings or whatever they own in Brazil. So therefore, it's a pass for me. But if you have comfort with the buildings and with the financials, yeah, it's another way to play it for sure. Yeah, you're probably right, but it's not for me. I never take company and country risk. So, if I was going to play, like, with China, I took the best, most secure company when no one wanted China. With oil during COVID, I took the best company during the lows, which was Exxon. I took Wells Fargo at $25 when you couldn't give away a bank during COVID. So for me to play the country and leadership risk in Brazil with a REIT that I have no edge on is not the way I would play it personally. But if you're a regional manager, I mean, it generally looks okay if you understand the underlying assets perfectly. Anna Gutowski. No, they want to come on the podcast. We don't accept guests unless they're rock stars. Matthias or CEOs of companies we own, more likely. Matthias Hambach. Appreciate it. Let's see. When was it? Okay. I appreciate all that you and your public service to us. You made me a better investor, especially evaluating jockeys, investing in Fraport, Lehman, Frankfurt, COVID. Okay. So this is an airport company. Okay. Fraport. Airport. Okay. Still generating negative cash, declining margins. Not something I want to jump on right here. And let's just see. Okay, that's a client request and another client coming in. Okay, so with that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.